Imagine waking up tomorrow morning, checking your email, and finding out that by the end of the year, you are personally responsible for supplying enough electricity to power an entirely new, medium-sized city.
Yeah, that sounds like an absolute nightmare.
Right. And not just anywhere. You have to do it in the rolling hills of West Virginia.
Oh, wow.
Yeah. The infrastructure isn't there, the funding isn't secured, but the demand is absolute. That is the sheer scale of the reality we are looking at today.
It really is. It's wild.
We are doing a deep dive into FirstEnergy Corp's Q2 2026 earnings report and their strategic highlights, which were published on July 28th, 2026.
And this is not just your standard numbers review.
Exactly. The mission of this deep dive isn't just to read off a balance sheet for you. We're going to decode these documents to reveal a massive, largely hidden growth engine.
Because on the surface, a utility company seems pretty dull.
Yeah, totally. But we're looking at how this supposedly boring traditional electric utility is quietly serving as the critical physical backbone for the booming tech and AI revolution.
Which is something I don't think a lot of people fully grasp yet.
Okay, let's unpack this by starting with the core numbers. Because we need to establish the baseline financial health for the second quarter of 2026 before we get into the wild sci-fi growth stuff.
It makes perfect sense to start there.
Yeah.
Because, you can't fund a tech revolution if you can't pay your daily bills.
Right. So the headline figures show that both GAAP and core earnings per share, or EPS, came in at 50 cents.
Which is a solid baseline.
Yeah. And revenue grew to $3.7 billion, which is up from $3.4 billion in the second quarter of 2025.
A very healthy jump year over year.
Definitely. They are also reaffirming their full year 2026 core EPS guidance of $2.62 to $2.82. And they're keeping a trailing 12-month earned return on equity, or ROE, of 9.5%.
Okay, so that's a lot of numbers right out of the gate.
It is. Let me stop right there, actually, because I want to make sure we aren't just throwing alphabet soup at you, the listener.
Always a good idea.
For someone who doesn't spend their day building discounted cash flow models, why do we care about both GAAP and core EPS? Like, what's the difference?
Those are fundamental questions.
Yeah.
So GAAP stands for Generally Accepted Accounting Principles.
Right.
It's the strict, standardized way the government makes you report earnings. It includes everything, including, one-time write-offs, legal settlements, or weird tax anomalies.
Stuff that doesn't happen every day.
Exactly. Core EPS strips out that one-time noise. It tells you how much money the actual recurring engine of the business is making.
Okay, so the fact that both came in at 50 cents.
That means it was a very clean quarter. There were no massive accounting distractions messing with the numbers.
Got it. And what about that 9.5% return on equity? What does that actually tell us about the company's health?
Well, return on equity is essentially a measure of capital efficiency. For every dollar of shareholder money FirstEnergy is sitting on, they are generating 9.5 cents of profit.
Which sounds pretty good, right?
It is. And that 9.5% target is crucial because utilities are incredibly capital-intensive businesses. They need to constantly attract new investment.
Because they're always building stuff.
Exactly. If that ROE drops too low, investors will just take their money somewhere else, like tech stocks or treasury bonds. And then the utility won't have the cash to build new power lines.
Which brings us to a really interesting anomaly in this report.
Oh, the distribution segment.
Yeah. When you look at their distribution segment, which is the part of the business that actually delivers power to homes and businesses, the core earnings were actually down 6 cents per share year over year.
Right.
Now, normally, if I see a segment's earnings drop, I just assume something is broken.
Usually a safe assumption.
But the report explicitly flags this as being driven by higher planned maintenance expenses.
And that distinction is vital. I mean, this isn't money vanishing because of bad management or lost customer.
Right. It's intentional.
Exactly. This is money being purposefully, strategically deployed into the physical grid. They're actively choosing to take a hit on their short-term earnings in that specific segment to fund essential heavy-duty maintenance.
I look at it this way. It's like spending a weekend and $1,000 changing your car's timing belt instead of, I don't know, going out for a fancy dinner and a show.
That's a great way to put it.
It hurts your wallet today, sure. It looks like a loss on your weekly budget. But it prevents a catastrophic engine breakdown on a cross-country road trip tomorrow.
Precisely. You're investing in reliability.
But beyond just fixing old wires and replacing a few wooden poles, what is the actual return on investment here? Like, how do we know throwing millions at maintenance actually does anything for the grid?
We know it's working because they track it meticulously. The report highlights a 12% year-over-year reduction in SAIDI.
HIED, what is that?
It stands for System Average Interruption Duration Index. It is the gold standard metric in the utility world. It basically measures how long the average customer sits in the dark when the power goes out.
Oh, wow. So a 12% improvement in just 1 year seems massive for physical infrastructure that covers, what, multiple states?
It is a massive leap. I mean, moving the needle on SAIDI by double digits doesn't happen by accident.
Yeah, that takes real effort.
It proves that the higher maintenance expenses in the distribution segment are translating directly into a more resilient grid.
And what does that mean practically for the person listening?
Practically, it means installing smart switches that can automatically reroute power around a fallen tree.
Oh, that's cool.
It means aggressive vegetation management so that tree doesn't hit the wire in the first place. It means replacing aging substations.
Got it.
The financial impact of the maintenance cost is temporary. In fact, they expect it to reverse in the second half of 2026. But the structural improvement is permanent.
So if they're successfully making the grid that much more reliable right now, it begs the question, what massive wave of demand are they fortifying this grid against?
And that is the billion-dollar question.
Why the sudden urgency? Right. That leads us to the most staggering numbers in this entire report. FirstEnergy's total data center demand pipeline has hit 24.8 gigawatts.
Which is just a huge number.
It's massive. That is a 30% increase just since the first quarter of 2026.
Yeah.
And their contracted demand, meaning the demand that is legally locked in with agreements, is now at 6.4 gigawatts. That's a 50% jump in a single quarter.
We need to pause and really emphasize the scale of that. Historically, utilities are used to growing demand by maybe 1 or 2% a year.
Right, just normal slow growth.
Exactly. It's usually tied to slow population growth
Yeah.
or someone building a new strip mall down the street. A 50% jump in contracted demand in 3 months is unprecedented.
It's completely unheard of. To put a gigawatt in perspective for you guys, 1 gigawatt is roughly the amount of power needed to run a medium-sized city.
Yep.
So 6.4 gigawatts of contracted demand is like adding several major metropolitan areas to their grid overnight.
And it's entirely driven by technology and data centers.
It's crazy.
The AI revolution requires massive server farms, and those servers run incredibly hot. They require almost as much power to cool as they do to compute. That is what is driving this demand.
Here's where it gets really interesting. The standout statistic in this report is where this demand is exploding.
Right, the location.
Demand in West Virginia specifically is up an incredible 137% to 4.3 gigawatts.
That number still shocks me.
I have to admit I'm confused by this. When we think of Silicon Valley or tech hubs or AI innovation, we don't usually picture the hills of West Virginia.
No, definitely not.
Why is this happening there, and how does a utility physically handle that kind of overnight hypergrowth?
It's a great observation because it completely flips our traditional geographic map of the tech industry.
Totally.
Why West Virginia?
Sure.
It fundamentally comes down to 3 things: space, cooling, and legacy infrastructure.
Okay, break that down for me.
So tech giants looking to build massive multi-building data center campuses need vast tracts of cheap land, which West Virginia has. They also need access to water for cooling. And most importantly, West Virginia has a long legacy of heavy industrial and coal power generation.
Ah, so the power lines are already there.
Exactly. There are already massive high-voltage transmission corridors running right through the state. You don't have to spend a decade fighting for the right-of-way to build a new power line.
The spine is already built.
Exactly.
Yeah.
FirstEnergy is advancing things like the proposed Maysville Energy Center in West Virginia to tap right into this reality.
But even with existing corridors, I mean, physically handling a 137% growth spike has to be an engineering nightmare.
Oh, absolutely.
You can't just plug a billion-dollar AI data center into a standard wall socket.
No, you really can't. It requires re-engineering the region's entire power backbone. And the report gives us a fascinating financial rule of thumb for what that actually costs.
So what's the rule?
They state that it requires roughly $250 million in transmission network upgrades for every 1 gigawatt of new demand.
Okay, wait, $250 million for 1 gigawatt.
Yes, for every single gigawatt.
What exactly is that money buying? Because that sounds like a lot for copper wire and wooden poles.
Well, we aren't talking about wooden poles here.
Fair enough.
We are talking about securing land rights, building massive new high-voltage substations from scratch, and installing heavy-duty house-sized transformers.
House-sized.
Yeah, transformers that can step down hundreds of thousands of volts of electricity for these massive server farms without melting.
Wow. Let's do the math on the contracted demand then.
Let's do it.
If they have 6.4 gigawatts locked in, and every gigawatt costs $250 million, you are looking at over $1.5 billion in required capital just for the transmission network.
And that doesn't even touch the massive 24.8 gigawatt pipeline waiting in the wings.
Which highlights an obvious, glaring financial dilemma.
The funding.
Yeah. If FirstEnergy needs to spend $250 million for every single gigawatt, how do they actually pay for it?
That's the challenge.
More importantly, how do they recoup those costs without bankrupting the everyday residential consumer who just wants to, keep the refrigerator running?
That is the central tension of modern utility management right there. A utility can only grow its earnings if it can grow its rate base.
And the rate base is what, exactly?
The rate base is the total value of the physical property, the lines, the substations, the transformers, on which the regulators permit the company to earn a specified rate of return.
Okay, I'm following.
But if FirstEnergy spends billions today and then has to wait 5 years for a public utility commission to let them charge for it, the financial strain would be catastrophic.
So they have to move incredibly fast, not just with the bulldozers, but with the paperwork.
Precisely.
According to the report, FirstEnergy is on track to deploy $6 billion in capital investments in 2026 alone.
Which is huge.
They have already invested $2.9 billion year-to-date, which is a 19% increase from last year.
And we are seeing the results of that spending.
Right. Their integrated segment transmission rate base is up 22%, and the standalone transmission is up 11%.
But to pull this off, they have to use a specific strategy.
Yeah, the report notes that 75% of their projected investments are in what they call formula rate recovery to reduce regulatory lag.
Which is a bit of jargon.
It is. Let me use an analogy here. Is formula rate recovery basically a fast pass at an amusement park?
I like where you're going with this.
Like, instead of waiting in line for years to ask the Public Utilities Commission to approve a rate hike to cover costs, the formula just automatically adjusts based on what you spent.
What's fascinating here is how that mechanism actually evolved. Regulatory lag used to be a deliberate feature, not a bug.
Really? Why?
Well, regulators wanted a delay between when a utility spent money and when they could charge for it. It was to prevent utilities from gold-plating the grid building, unnecessarily expensive things, just to artificially increase their rate base.
I see.
Historically, a utility had to file a massive base rate case, argue it out in court-like hearings for 18 months, and just hope they got approved.
But I imagine waiting 18 months for every single substation approval would completely stall out this AI data center boom.
Precisely. The speed of the tech industry demanded a change. So regulators created formula rates.
Okay, so the fast pass.
Your amusement park fast pass analogy is spot on. It is a predefined mathematical mechanism. If FirstEnergy spends X dollars on a qualified transmission upgrade for a data center, the formula automatically adjusts their customer rates by Y amount to recover the cost.
Hold on, let me push back on that a bit.
Sure.
If I'm a consumer listening to this or a small business owner, that sounds a lot like the utility just gets a blank check to raise my rates whenever they spend money.
I know, it sounds a bit scary.
How is that fair or even legal?
It sounds alarming, but it's not a blank check. It is heavily audited.
Okay.
The utility gets to adjust the rate quickly, yes, to maintain their cash flow. But there is an annual true-up process.
What does that mean?
Regulators go back and scrutinize every single receipt from the year. If FirstEnergy spent money recklessly, or on things not covered by the formula, they are forced to refund that money to the consumer, usually with interest.
Oh, well, that makes a lot more sense. It changes the speed of the cash flow, not the rules of the game.
Exactly. It provides the financial velocity the company needs without entirely removing the regulatory oversight.
And they do still have traditional rate cases in the mix, right? They aren't bypassing the standard process entirely.
No, not at all. They still have to manage base rate cases for the distribution side of the business and in certain jurisdictions.
Like where?
Well, the report notes they're expecting to file standard base rate cases in New Jersey and Maryland in the third quarter of 2026.
Okay.
They're also expecting an order by the end of July 2026 for West Virginia's Inflation and Investment Adjustment Mechanism. And they recently had a $2.5 billion three-year rate plan accepted in Ohio.
So they are basically pulling every regulatory lever available to make the math work.
They absolutely have to.
But balancing this aggressive $6 billion a year investment fast track with corporate financial stability sounds like walking a tightrope in a hurricane.
It's not easy.
You have to build fast enough to satisfy Google and Microsoft, but carefully enough that you don't spook Wall Street.
Exactly.
So what does this all mean, whether you're a ratepayer trying to understand your bill or an investor holding a utility index fund in your retirement account? We're seeing huge capital deployment and massive new debt. Is this a grow at all costs era for utilities now?
If we connect this to the bigger picture, it is exactly the opposite. It has to be a grow with intense discipline era.
Intense discipline.
Yes, utilities are shedding their old reputation as slow, boring dividend stocks.
Yeah,
But growth at all costs usually ends in bankruptcy.
sure.
FirstEnergy is going out of its way in this report to assure the market that they have strict guardrails in place. For instance, they are targeting a ratio of roughly 14% for FFO to debt.
FFO to debt. That's funds from operations to debt, right?
Yes.
Basically, a metric showing how easily their actual operating cash flow can cover their massive debt obligations.
Spot on.
But why 14%? What is the magic of that specific number?
That 14% is the magic number because it is the threshold demanded by the major credit rating agencies. FirstEnergy is deeply committed to maintaining a BBB or BAT2 credit profile.
Which is investment grade, right?
Yes, it's investment grade at all three major agencies.
Let me guess. If they drop below investment grade, the whole machine breaks.
It completely breaks.
It's like trying to qualify for a massive mortgage to build an addition on your house while simultaneously convincing the bank you aren't going on a reckless spending spree.
That is exactly what it is. When you're borrowing billions of dollars to build $250 million transmission lines, a downgrade in your credit rating means your interest rates spike.
And your borrowing costs go through the roof.
Right. That alone could derail the entire growth plan and destroy shareholder value. By fiercely defending that BBB credit rating, they ensure they can continue to borrow cheaply and sustainably.
And according to the report, they are funding this $6 billion growth plan through a very deliberate mix.
Yes, they laid it all out.
It's cash from operations, debt, and modest equity. They aren't just putting it all on the corporate credit card.
No, they're being smart about it.
But they also aren't flooding the stock market with millions of new shares, which would dilute the value for current investors.
It's a highly calculated triangulation. They use operational cash first, layer in responsible debt that won't threaten the BBB rating, and use equity modestly just to keep the balance sheet strong.
And because of this extreme discipline, management is confidently forecasting something big.
Yeah, they are.
They say they will deliver near the top end of their 6 to 8% core EPS compound annual growth rate, or CAGR, all the way through 2030.
Promising top-tier growth for the next 4 years straight is a bold statement.
It really is. It tells me that FirstEnergy fundamentally believes this demand from AI and data centers isn't just a flash in the pan.
No, it's not going anywhere.
It's not like a crypto mining fad that will vanish next year. It is a sustained, multi-year, structural driver of their core business.
They are executing a high-growth strategy driven entirely by external tech factors while meticulously managing their internal financials.
It's a tough balancing act.
It requires flawless execution on the engineering side to actually build the physical grid and flawless execution on the regulatory side to get paid for it without crippling their balance sheet.
It really is an incredible transformation to witness.
Yeah.
Let's recap the journey of this deep dive for you guys.
Let's do it.
We started by looking at standard, seemingly mundane utility earnings numbers. A solid 50 cents per share, $3.7 billion in revenue, and some targeted maintenance expenses that successfully drove a 12% drop in outage duration.
Yeah, basics.
Right. But by peeling back the layers on those numbers, we uncovered a massive $6 billion a year infrastructure play.
A play that is entirely driven by the AI and data center boom.
Yeah, completely revitalizing legacy and industrial hubs like West Virginia, where power demand is suddenly up 137%.
And we saw how they're utilizing modern regulatory tools, like that formula rate recovery we talked about, to reduce historical regulatory lag.
The fast paths.
Exactly. It allows them to fund this explosive, unprecedented growth while maintaining strict financial discipline, protecting the consumer through annual audits, and defending their investment-grade credit rating.
If you are listening to this, whether you're just analyzing your local utility bill or you hold utility stocks in a retirement account, this shift matters immensely.
It affects everyone.
The landscape of American infrastructure is changing right beneath our feet. The electricity that powers your smart home and the massive gigawatt-scale data centers running the AI tools you use at work every day are fundamentally reshaping what we used to think of as boring utilities.
They aren't boring anymore.
Not at all. The physical world is engaged in a massive multi-billion-dollar sprint just to catch up with the digital world.
It is a sprint that is going to redefine the industry. And it leaves us with a fascinating, slightly provocative dynamic to watch going forward.
Oh, what's that?
Well, data centers require so much dedicated, massive scale power. I mean, we are seeing FirstEnergy contracting multiple gigawatts at a time for single customers.
Massive scale.
As this scales up, will we soon reach a tipping point where the tech giants themselves decide they can't wait for public utility commissions at all?
Wait, what do you mean?
Could we see a near future where the biggest AI companies bypass traditional rate structures entirely and essentially co-own the grid?
Oh, wow.
If that happens, it would blur the line forever between what is a public utility and what is a private tech asset.
That is a massive question, and it's definitely something to keep a very close eye on as this unprecedented demand continues to reshape the map. We'll be keeping tabs on it here, so be sure to follow the show for our daily earnings coverage so you never miss a deep dive.
Catch you next time.